G'day guys, thanks very much for joining us for Catapult Wealth Market Update. Today we've got Analyst Bill Keenan. He's the Director and Founder of Bluebird Portfolio Services and ex-head of Lonsec. Bill, thank you very much for joining us.
Thanks, Tim. Glad to be here.
We've had an incredible rally in the US, and even Australia's had its own little mini rally. It's a bit of an amazing situation where there's lots of bad news, but the markets seem very, very resilient.
Yeah, I think that liquidity, the Federal Reserve's liquidity and the federal government's deficit spending has led to a lot of stimulus, which has ended up in the equity markets. But at the moment, I guess Main Street or the economy seems to be much different to Wall Street at the moment.
Yeah, well, like they say, you know, the stock market is not the economy. Do you think we're seeing a bit of a major divergence here?
Yeah, I think it is, and which one will be right in the end? I think that in the end that the rally will struggle, and that the reality of what's going on the ground will be a little bit more sobering than what's in the market at the moment. So it does seem like a bear market rally at the moment, even though it is quite strong and quite convincing. We still view it as distant to the fundamentals at the moment.
Bill, take it away. Tell us what you think is going to happen in the next few months.
Okay, well, we've got this market update for you. It's only about 10 to 15 minutes. We'll just run through it very quickly. Tim, I understand you might have some questions as we go through. Just the first slide here is just general securities advice. We have to say that it's not personal advice. Now, we recently just talked about this is the massive recovery in the US market, you can see here. And it got to within 5% of its highs, which is quite remarkable given the impact that's happened to the physical economy and the massive amount of unemployed and the big hits to GDP, etc. And we think a lot of this is related to the tech stocks, which represent around 35% of the index. And indeed, tech stocks are doing better in this sort of environment of online, people using online products, goods and services a lot more. But the rally does seem a bit skinny, and it's been coming off recently, looking a little bit more shaky, a bit more volatile. So we're a bit suspicious about this rally, as we've already mentioned, that whether it can hold. If you look at the Australian market, much more reserved, and the reason for that is that the banks make up a big chunk of the market here, and the banks haven't really recovered as yet. And in addition, we've got about 3% of our market in technology stocks, so we don't have much technology stocks to really boost the market, although they have been rallying here. But essentially, it's still been a reasonable rally. It's only 15% off the highs or so, which has been a pretty good rally, but we're just struggling at the moment to get above 6,000 at the moment. Now, this is the economic outlook at the moment from the Reserve Bank, which we think is probably the best example to look at. And the Reserve Bank's got three scenarios: upside, baseline, and downside. And we think probably looking at baseline, the purple line, it seems like the economic recovery in Australia is a bit better than what people were expecting so far. So we don't expect the downside, but we do expect that it will struggle to get back to par or 100, which is 2019 numbers. We think it will struggle because of the gap in consumption that will be ahead, probably also business spending. So we think there will be permanent change to psychology of consumption and also businesses moving forward.
It's interesting with such strong retail sales numbers out of the US and Australia as well, Bill.
Yeah, there's been some jumps in those, as you'd expect, but it's probably more the trend of where they're going and also whether they can get back to par. And there's going to be some volatility in the numbers because they're all jumping off very low bases. But it's the trend of where they're going and what they can sustain. So I guess we're forward looking a bit more. We're really looking forward into the September, December quarters here as to where things are going.
There's been a lot of stimulus checks in the US and here, and lots of cash being flashed around.
Yeah, and that is going to boost things short term, and it's going to muddy the waters. And I guess we're looking through that, looking at sustainable growth, sustainable earnings moving forward. Very hard to read, of course, at the moment, but this is just our view on how things are going to evolve from here, from our experience over the last 25 years or so. Looking at inflation, there's a bit of debate in the market about inflation and deflation, and we think that inflation, talk about that, is premature, very premature. There has been a lot of liquidity and stimulus from the central banks and the government, but that sort of stimulus is really just filling the gap that in the economy. There's been a massive gap, what they call the output gap, and it's just trying to fill that in. Now, there's job keepers and other things like that, but it's not going to totally fill that gap. And at the same time, bank credit has decreased somewhat, and there's not enough to create an inflationary spike. So we think that deflation is more likely than inflation because excess of goods and services, people discounting at the moment just to get sales because of that lower consumption. Lower oil prices will have a follow-through effect on transport costs. Lower business OPEX and CAPEX at the moment, so businesses are spending less also. There's excess supply, labour building up in the economy, which means less wage inflation. Wage inflation was already fairly benign. And lastly, we're seeing a lot of this technology-enabled robotics, automation, online productivity coming through, and generally leading to lower costs and lower margins for businesses. And that generally seems to be a deflationary trend rather than an inflationary trend. So deflation is what we're betting on more so than inflation. And this is
it's very everyone's comparing it to the Japan story. Do you think we're heading that way, or do you think we can stump it?
I think we are definitely headed for a Japan-style situation globally in the developed world. It's very difficult to see how we're not with these charts that we're about to show, which just look exactly like what the Japanese bank has been doing for the last 10 years or so. We're now doing that, following the same footsteps, and really, we know where it all ends: low growth and very low inflation. And at some point, we'll need some sort of restart of the debt that's been built up. That's probably way down the track. But for now, we are going down this money printing episode where the major developed economies, the currencies of the world, the Fed, the ECB, the Bank of Japan, and the Bank of England, they're all doing this massive money printing, which just means they're expanding their balance sheet and they're providing liquidity and buying up bonds to drive down yields. And they're creating this money basically out of thin air. And they would say to defend themselves, they will take the money away eventually as conditions return to normal. But as we know, since the GFC, conditions have never really returned to normal, and they haven't really been retreating much, particularly the Bank of Japan. So it's a bit like the boy who cried wolf, I guess. It just becomes something that you don't really believe that they will ever retreat from this position, and it'll be very hard to retreat from this position. And our Reserve Bank was reluctant to do this, but even our Reserve Bank has entered this game recently, buying up around $80 billion in the bond market and supplying liquidity to the banks. And look, it's been successful in the short term. They've got the 3-year bond down to 0.25%, and that was their target. So interest rates now from cash out to 3 years, pretty much 0.25%. So if you're wondering who's responsible for these very low interest rates, it is the central banks of the developed world.
Should we be worried about all the money printing really devaluing our currency, or given that everybody's doing it at the same time, it sort of cancels each other out?
Yeah, it's a good question. So all currencies are relative. And since we just mentioned that all the major central banks of the world are doing it, it's sort of okay at the moment because it's, everyone's doing it. So it's all relative. And in fact, that's probably why the Aussie dollar rallied, because the scope of our money printing is much smaller than what the Fed has been doing. So therefore, that was probably the major reason the Aussie dollar rallied. Overall, it's okay for now, but we have a worry that down the track that the worst culprit, the Bank of Japan, which has, we haven't got a separate chart for that, but it is much worse when it comes to budget deficits and how much the central bank has bought up of assets in Japan. And there could come a point where the yen falls more than the other currencies just because of its relative position. And if it did that, you would see inflation, not here in Australia, you'd actually see it in Japan, because everything they try to buy from offshore would cost them a lot more because of the cheaper yen. So that's how you could get inflation, but that's more an end game and more of a crisis down the track. So at this stage, the central banks are looking for inflation, and it is viewed as good, but there'll be a price to pay later on if they go too far down this track. So
against money printing is that it can create a asset valuation bubble that doesn't really translate to the real economy, to real jobs. Is that
and there's debate that it causes social divide, because low inflation, low wages doesn't really help, blue collar workers. It's only asset prices that have been going up because of the very low interest rates. But the Reserve Bank would argue that lower interest rates help the economy and jobs have a broader effect than just asset prices. But there's been this debate about whether it's just helping Wall Street versus Main Street, and that's been a bit of a debate. And you can see the yield curves here that we got. They're actually very flat all the way out to 3 years, basically 0.25, and then they spike up. But really, in context, you're talking 0.9%, 10-year bond in Australia and 0.7 in the US, so very, very low. And the central banks have actually manipulated this market to make sure that it stays at that level. And so that's what's forcing interest rates so low. I mentioned the Aussie. It did rally, and we think it's because of the Fed's money printing was at a larger scale than anyone else. But also a couple of commodities of Australia's have held up pretty well, and they're reasonably sized commodities by value, and that's iron ore and gold. They're in our top 10 exports, and iron ore being number one. And those commodities have held up reasonably well, and it's probably helped gold, the currency, just short-term spike, which we don't think will be sustainable because it still will mean that there'll be some other issues for the Australian economy as we move through. I mentioned coming up about the bank impairments at the moment that we might have. And so there's some other issues we have to deal with. So we're skeptical it can hold above 70, but it'll probably hold around 65 to 70 now. Now, this is just our debt here in Australia, the government debt, and what's going to happen to the government budget deficit. Now, we usually have a May budget update, and we haven't had anything like that, but there should be something sooner or later that says that we're going to have about $160 to $180 billion deficit. That's actually better than what they were expecting before. They were expecting 200, but that's about 8 to 9% of GDP. It's a bit of a blowout. And the debt's going to go from about 45% to 60% of GDP. That's the net debt. You might see higher figures than that, and that's because of the gross debt is different to the net debt because of the future fund has to be netted off. That's worth 200 billion or so. So look, our position is getting worse, far worse than it was back in 2010, where we only had 20 billion in debt. And look, it's headed the wrong way, but in the context of the developed world, we're still AAA rated at the moment, which is much better relative to the developed world. And this is the US.
When we have a huge budget deficit like that, at some point there's usually a period of austerity, which is higher taxes, lower spending. But that's much further away in the future. So this really isn't a problem now. How far away do you think they might actually look to?
Well, it should normalise back as they roll off JobKeepers and get back. But where will it normalise? And you can see there's some downside baselines here, but it's definitely going to normalise as a deficit. So the issue is, will they try and get it back to surplus? If they do, they'll have to rejig the tax laws. But I think if the economy's struggling, the view at the moment is they'll actually probably look to lighten company tax or reduce taxes to sort of boost the economy. So we are definitely looking at a deficit, but there's a bit of moral hazard here because the central bank is, remember, keeping interest rates very low. So does that give the government a green light to just go and spend what it wants? And that's the moral hazard of what these central banks are doing, is that governments, they want to be elected and they want to get in. No one wants to do the tough things, and that is raise taxes and cut spending. No one wants to do that. So there's a real hazard with what the central banks are doing, is it's just giving basically a blank check to the government to just spend. Now, and the US has taken that blank check and absolutely gone bananas. So if you look at, this is Republican government too, they're going to take this budget to 4 trillion. I mean, they just keep stacking on 1 trillion as each month goes by, a trillion here, a trillion there. They're up to 4 trillion is where I believe they are. 20% of GDP, which is the green line. It's going to be a big blowout. And then the actual federal debt, it's on the way to 25 trillion. Now, the US economy is worth about 20 trillion. So it's on the way to 125% of GDP. Now, remember, our debt's around 60% of GDP. So they're headed for double where we were. They used to be okay, but they used to be under 100. But now they're really headed well over 100% of GDP, right up to where the European economies are and headed towards where Japan is even. So in theory, their bond yields should be going up because their credit quality is getting worse, but their bond yields are being magically held down by the Federal Reserve. So you can see the manipulation that's going on at the moment. Now, this is an interesting chart about iron ore, about how it recently spiked from, it was getting down to $80 a tonne and we were getting a bit worried about it. This is our number one export. And then there was all this China to and fro going between Australia, and they were starting to put tariffs on barley and reduce imports of beef. And now they're sending warnings about our tourism and our racists here in Australia. And yet the iron ore price just kept going up. So what seems to have happened is that Brazil, because it got in such a mess with coronavirus, it seems to have disrupted their iron ore supply. And Australia and Brazil are the major global producers of iron ore, and that is why the iron ore price has gone up. And China still needs it for their steel manufacturing. And so it's gone above $100, and it's been a positive for BHP and a lot of the other resource stocks. So that's been a bit of a surprise to us. And at the moment, resource stocks are holding up a bit better than we thought they would. Now, this is fossil fuels. We've been bearish on fossil fuels for a while, and they haven't been holding up as well. Now, so the three here, we've got thermal coal in black. It's gone from a bit over $100 to $55 a tonne. Brent oil's gone from, in blue, well over $60 a barrel to 20, and then back up to 40 at the moment. And LNG is very much tied to Brent. Oil has fallen from $10 a tonne on the left-hand side axis to $2 a tonne, which is absolutely a crash. And that really affects Australia because we're one of the largest LNG exporters in Australia. We're not big on oil, but we're big on LNG, and we are big on thermal coal and indeed coal. So those two do hurt us. And look, 9 million barrels of demand have been destroyed by COVID. And previously demand was 100 million barrels a day. So that's 9% of demand destroyed. And how much of that will come back, we don't know. But while the airlines are down, obviously that impacts it a large degree. But also light vehicles is around 36% of demand. But on top of that, we already had problems with fossil fuels, and that was reducing demand because of the need to reduce pollution immediately in the big cities, but also carbon emissions over the medium to long term. So there is already a move away to renewable energy, away from coal. And if electric vehicles come in, which seem inevitable, renewable energy is now competitive at around US $10 to $20 a barrel for electric vehicles, being so much more efficient from the electricity network to the vehicle. It's a lot less wastage than combustion engines. And with battery storage becoming cheaper and cheaper, it's becoming more promising that renewable can replace a lot of the baseload generation. So we think over the next 10 years, electric vehicles will continue to come in, and that will displace roughly 36% of demand for oil with light vehicles. So there's a bit of a risk there, and we're a bit bearish on fossil fuels moving forward. Indeed, we took Woodside out last year, and we are continuing to remain bearish on the energy stories. This is the bank situation, which essentially here you can see the scale of the bank's loans, which are nearly 3 trillion. And we have the deferred loans here of the banks being 234 billion. We know this because we got the statistics from the Australian Bankers Association. Now that represents about 8% of their gross loan book. So basically 8% of their loans have been deferred in September, October, and the banks are working on getting a solution to these deferred loans so that they don't become impaired. So look, there's a fair whack at the moment, 8% of the loan book. Now, how much of those will go bad, we don't know, but at the moment, their banks have provided for 0.8 of their gross loan book. So you can see that the scale of the provisions is reasonably small versus the deferred loan book at the moment. But of course, not all those deferred loans will become bad. And there is security probably held against a lot of those loans. But the GFC experience was 0.9. You can see here that it got up to nearly 1%, and they have provided for 0.8. So they have a GFC scenario covered. But this time with 8% of the loan book deferred, it looks like we could be headed for somewhere a bit more closer to the 1990 recession, which was 1.5 to 2.5 of the book. And so if we get closer to that level, then 0.8 won't be enough. So that is why the banks just are not getting up at the moment, because there's a bit of a worry that the provisions might be needed as yet, depending on what happens with these deferred loans. And while the banks have to keep making provisions, they can't go back to normal profit and normal dividends. So that's just what's holding them back at the moment. And we'll continue to watch that 234 billion and see what happens with it. It's roughly 60 billion small business loans, and the balance is first mortgages. So that's how that's come about.
You have a prediction, Bill, in terms of if loan payments are worse than expected, will they completely skip dividends, or do you think they'll just reduce them?
I think they might have 1 year to 1.5 years of very low dividends and then come back. If they're at 0.8, and I'm thinking a worst case scenario might be 1.5, it just means another half year to a year of pain, and then hopefully they're through it. I don't want to think about any more than 1.5 because we're getting into pretty bad scenario then. And 1990 was a pretty bad scenario, but back then we had interest rates of 18%. This time we've got interest rates of 2%, and attitudes of government and banks are much different this time, where they're trying to help people. Where back in 1990 it was a much more ruthless, businesses go bankrupt. It was much more ruthless, and nowadays there's a period of trying to work through issues a bit more. So I'd be expecting 1.5 to be as bad as it gets this time around, and we'll see. But if we're lucky, it might only be 1%. And then the banks are at 0.8, so they'll only need a little bit more to sort of, get things covered. So that really is the future of the banks, is that what happens with impairments, the short-term future anyway. I'll just sort of toss in something positive here. At the moment, there is the 5G rollout going on. It's fairly quiet. It's behind the scenes at the moment, but you'll hear more and more about it. Essentially, they are rolling out networks that are a lot faster. There's more cells, there's more towers. They have faster connections, so there's lower latency or lower ping rate. And the speed should be around 50 megabits per second at least. And look, it should be reasonably good, really reasonably solid. Not for everyone. Some businesses will still want to use the NBN. Some houses will still want to use NBN. Fixed line will always be superior. But the wireless will get so powerful that it may become an option for many households, but particularly renters that move around, various consumers. And, the wireless network will be available on a hub like this as a separate network to your mobile phone. And so you'll have a different option to the NBN for broadband. So this should be a new revenue arm for Telstra and for the other telcos. So hopefully it can reinvigorate some revenue for Telstra, and we're hoping that it can get it going again. So that's why we've started to move into Telstra already, expecting this 5G to bring new revenues. Now, this is our view on sectors at the moment. These are the major sectors of the market. Now, banks were neutral on because they look cheap, but there are still doubts about the loan impairments, which just holds it back from being a tick at the moment, and we sort of need to just watch and see what happens there. Wealth management is a tricky business at the moment, but we do pick out a few stocks that we think are okay in terms of the ASX, Magellan and Netwealth, which are benefiting from current conditions generally. Insurance we don't like because we've seen high claims for a long time now in terms of climate change and droughts and floods and hailstorms, and now business disruption insurance, all sorts of things. The claims just keep coming, and we don't like the sector due to that claim risk and very low returns they receive on their cash and bonds. We just saw a couple raising from Challenger the other day. So that's a good example of how the insurers are struggling at the moment. Resources we're neutral on while iron ore holds together. If iron ore starts to come off, then we'll start to get a bit more worried because that's the big one for Australia. So we're neutral on that at the moment. Gold, we're still bullish on. The reason is mainly the money printing. Tim mentioned that currencies, they're all relative. So you can't really see a depreciation of the US dollar because it is only measured against other currencies, and all other currencies are doing similar things. But you can see it in the gold price, and that is where the value of the US dollar is going down because the value of gold is going up. So you can see it there, and that is why gold is going up, because it's an absolute. So that is the number one reason why gold is going up. And we think the money printing won't stop, and therefore we think gold will continue to be in an uptrend. Energy, we've already mentioned that one, while we're bearish on that. Packaging, we're neutral on. Should be solid defensive, but probably not that much growth. Building materials, despite there being some little jumps at the moment because of better than expected conditions in the US and also a little bit of stimulus coming from the government, we're still a bit wary on the building material sector because housing is about 2/3 of the market. It trumps infrastructure, any infrastructure boom, and we're just thinking it'll remain cyclical while you're looking at a downturn globally. We're still thinking it's highly cyclical, and we're a little bit we like to avoid the building material stocks and engineers at the same time too. Consumer staples, very solid. We still like consumer staples as a key part or core part of our portfolio. Consumer discretionary is a very choppy sector, but there are some stocks that are doing well within it, and that is Wesfarmers and JB Hi-Fi. Generally, the home renovation, home office theme seem to be doing well at the moment. Healthcare.
Today alone explained the recent spike in retail sales.
Yeah, I think that a lot of it was home office, home improvement, home renovation, and also consumer staples, and that the major detraction or falls in retail sales obviously relates to restaurants and hospitality. That sort of areas are really suffering, but the consumer staple and I guess the more solid consumer discretionary spend is holding in there. Other consumer discretionary is much more choppy. For instance, apparel, super cheap auto hasn't been as strong. There's been many others that have been a bit more choppy. Healthcare is just rolling on as usual. It's been very good. And our selections have been doing very well. Industrials, again, choppy, but we believe Bingo and Brambles can come through this okay. They have too been a bit choppy, but we think they'll be okay. Brambles has got low gearing, so we think that they'll be able to support themselves. And Bingo, it's in waste and recycling, which is a fairly resilient industry. Infrastructure has become not as attractive. The revenue's now at risk more than anything, but the low interest rate environment is very positive. And we are still sticking with our selections of Transurban and Sydney, which are the two best quality assets, both compromised at the moment, but Transurban seems to be recovering relatively quickly. It's only around 10% below its to normal levels at the moment, which is quite a good recovery. But Sydney's obviously been decimated, and we are expecting about a 3-year recovery on Sydney Airport. It probably needs a vaccine to really get going, but we would expect the domestic environment to get going first, and that's about half of its revenue. So it's a good chance of its domestic revenue to get going in the next financial year. The communication, we've already mentioned that Telstra we're reasonably positive on, and Seek has been one that also has been doing well. We think it's a bit overvalued at the moment, but it could actually benefit from the high turnover in employment at the moment, with a lot of people being made redundant and then all of a sudden maybe rehired. Not sure how that'll pan out, but it could actually be to a benefit for Seek. So at this stage, though, we've got it valued around $19 and thinking it's a bit pricey here. And similar with our technology stocks, they've really fed off that boom in the US techs, and we're thinking that the Australian techs are a bit pricey here, and that Appen and Technology One, we just struggled to get to these valuations, and we have had a very good ride on them. And we're just saying, look, it's looking a bit pricey at the moment. And we found a little bit of value in AGL in the utility sector. It's got low gearing, doesn't have exposure to the LNG like Origin, and we just think it's a solid little yield play. And in fact, it's been moving up since we brought it in. So it does look okay as a solid little yield play that doesn't have that risk that the banks do in terms of maybe withholding their dividends for a period of time. And property, very similar to infrastructure. It's really an active market now. You can't just look at it as one market. You've got to look at it in terms of industrial, look at it in terms of whether it's retail supermarkets, whether it's hotels, whether it's office, residential. Each sector is very different now. And we're generally seeing that industrial is holding up really well in terms of Goodman and National Storage. But other areas like office, childcare, supermarkets, of course, been the worst affected. They all have doubts about their revenue and occupancy at the moment. Some of them have been raising capital. Gearing's generally been pretty good all the way through, so that's not the issue this time around for the property trust. It's just the revenue and the where the leases are going and where the cap rates are going in terms of the valuations moving forward. So property, we still are neutral on property infrastructure. We're not giving up on those sectors. We think when everything settles down, they'll still have a role to play in terms of reasonable income, reasonably solid assets. But certainly they've been a little bit volatile recently, but they should settle down. Just wrapping up, we've got a bearish short-term to medium-term view. So we just think this rally will fade and that the market will struggle to get any sort of trend in the next 1 to 3 years, that it will just sort of trade around, bounce around and not really make any progress. So we're preparing ourselves for that. Why are we like that? Well, we think there'll be some permanent damage from COVID, even though there will be a recovery. We think generally business spending and household spending will settle at a lower level than before because there'll be austerity, people will be a bit tighter. Higher unemployment also means that there'll be less spending from that component. There could be 1 million people in Australia underemployed in Australia in terms of on JobKeeper or not fully employed, unemployed, casual, etc. About 1 million people. There's only about 15 million in the workforce or so. Bank loan impairments is a bit of a risk for how the banks are going about offering credit. They might become a bit more cautious if they start to get a bit more worried about their loan impairments. And then lastly, large government deficits and debt. What will the government do moving forward to fix up its deficits and its debt? Or will it just become, not worry about it as much, So it's hard to say what will happen moving forward with deficits and debt. But you can already see the government wants to pull back from the JobKeeper spending and all those programs fairly quick. The other trend we're seeing is deglobalization is a geopolitical thing where we're seeing increasing political tensions within the US between the left and the right, and also Europe between the left and the right, but also between East and the West in terms of the, market-orientated capitalism model versus socialist central models. And we see China and Russia seem to be going back to their communist roots, whereas there's some question marks over globalization at the moment. So we're seeing a period of deglobalization and an unwind of what's been happening over the last 10 years. So we don't think that will happen permanently because technology is a great enabler for globalization. But at the moment, there's a bit of a pullback and a pullback to national boundaries at the moment. And lastly, company EPS growth. When we go to the bottom line and we look at the numbers ourselves and we do evaluation models, it's very difficult to get higher share prices at the moment because you're basically dealing with dips in revenue, which you're wondering whether the revenue can get back to par. Then you're dealing with issues around margins, lower margins. And then you finally, for a lot of stocks, you've got more shares on issue. And when you put all those things together, it's very hard to get a higher share price than you have now. And that is why it's hard to see the market have a bit of a bull run. So at the moment, we're expecting sort of bearish conditions until things settle down a bit. So that wraps it up. That being said, we think our quality approach, and we use a quality and a value approach, we have high defensive weightings, and we think we can still etch out an 8 to 9% return out of the Australian market, which will still be attractive versus cash and fixed term deposits. So that is our view. If we're wrong and the market's more bullish, all well and good. If we're right, then at least we're prepared for it and we can still try and focus on generating that return. All right, Tim, that wraps it up for me.
Yeah, brilliant. Thank you very much, Bill. It's like you said before, it's about probabilities. Seems like the market's sort of not pricing in the downsides enough, perhaps. But certainly they could keep rallying. There's certainly everything out there that's set up by the governments to allow that to happen. So
yes,
it happens. But look, thank you very much for joining us, Bill. And to all you guys that tuned in, thank you very much for your time.
Okay, no worries. Thank you.